All right, today we are going to talk about one of the most requested videos, which is about timing the market, why to try to time or not time the market. I'll tell you right up front, I don't do this. I already told you in my asset allocation video and in other videos, I don't time the market for a whole bunch of different reasons, but I'm going to talk about why. Now, before we even get into what we mean by timing the market, I'll kind of give you my four reasons up front. Those are number one, it's hard to time the market, meaning even though you might think you can do it easily and win, I will argue that you cannot. Number two, you create taxable events with the buying and selling, which is inconvenient and rarely advantageous. Number three, you can sacrifice dividends by timing the market. And number four, what money are you going to use to do this? And that'll make more sense a little bit later on in the video. Some of you who watched my asset allocation video will probably already know what I mean by that. So what do we mean by timing the market? Well, here's the idea. Here is a stock with price P at time T. So over time, the value, the price of a stock goes up and down. Now, let's say it's like super really easy and clear when the peaks and the lows are. The idea of timing would be, hey, you know what? I'm going to sell right here because stocks are really high. Stocks then go down. Once we've hit this bottom, I'm going to buy. I've now bought in lower. Now I'm going to ride the price up. And then once we get to this peak, now I'm going to sell. And then they go down. And so every time you do this, there's this amount, right? This change between the high and the low, you make money. And even though over this entire time, there's some average price that might be, we'll just call it 50 if this is 0 and this is 100. Even though the stock price has basically been worth an average of 50, you've taken advantage of all these gaps from, call it 100 to, 30 or something like that. And each time you're making $70 a share. Seems like a great idea, right? Well, maybe not so much. So the first thing to understand is that it's really difficult to actually know when you are at a top or bottom of the market. And I'm going to see if I can pull up a chart for everybody of this right now. Let's see. Here we go. So there's this really good page on Personal Finance Club, and you can just it's all about timing the market. And one of the things that it points out is all of the different tops and bottoms. And of course, the tops and bottoms depend on how zoomed you are. If you look at the COVID crash, which is the one on the upper right, you saw this big decline. And this was a point at which many people were saying, we're on the way down. It's going to go way, way, way lower. And then it didn't happen. And there were people who sold at that bottom, what we would call a local bottom, in the beginning of 2020, thinking it's going to go lower and then I'll get back in and then I'll ride it up. It didn't happen. Some of the best trading days of the year took place in just the couple weeks following that, and people lost out hugely. If it seems to you like, well, that's rare, it's really not. The 2008 financial crisis showed us this. If you look closely at the 2008 financial crisis, you'll see all these little declines. And at every one of these points, there were people saying this is the bottom, and there were people saying this is not the bottom. Some were right by chance, some were not. Then people saying this is the top, and then you saw declines. This is really difficult to do. In general, people are terrible at predicting where markets are going to go. We tend to get it wrong, and you also have to be right twice. You need to know, when do I sell and when do I buy? Or if you're shorting, it's the opposite, or whatever you're doing, you have to know twice. Where are the tops and where are the bottoms? 90% of actively managed investment funds don't beat the market. Most people who get out to get back in also lose compared to just staying in. Now, there's another really, really important sort of reality about this, and we'll go back to our chart. Really, this is not the way the market moves. So let's see if we can go back a little bit, and then we'll redraw this the way the market actually tends to move. And one of the really important statistics to understand is that if you look back at a 20-year period, right? January 1, 1999. So I'll put this period right, 1/1/99 to December 31st of 2018. During that time, if you miss just the top 10 days in the market, you were out, you were waiting to get in, or you were waiting to get out, or whatever, you were not in the market on those particular days. Your overall return was cut in half. Okay. Half of the return over this entire period happened on 10 days. Meaning if you mistime the market by just a day, a bunch of times, you're almost right. Okay. You're off by 1 day and missed those 10 days. You just lost half of your return. In reality, markets tend to move like this, and you see a decline and you think, oh, this might be the bottom. And then it's not. And then you say, wow, look at this peak. That must be the top. And then it flattens and then it goes back up and then down or whatever. Okay. Most of us have jobs. This is crazy. It's crazy to be doing this. Okay, so number one is that it's just really difficult to actually do the timing. Secondly, when you sell and have capital gains, there's long-term and short-term capital gains, you incur taxes. And when you have taxable events, now you have to look at, okay, do I owe capital gains at the end of the year? Do I have offsetting losses? It makes your taxes extraordinarily more complicated. And any of those taxes that you have to pay, you have to consider in terms of how it's affecting your real return by making these moves. I'm out and then I'm in and then trying to capture this delta. Number three, dividends. The longer you hold, in my case, it's very low cost index funds. The longer I hold those for the entire year, the more in dividends I'm going to be exposed to. When you look over long periods of time at your total return from holding an index fund that has the entire country, for example, it's an entire country index fund or a global index fund or a regional index fund, part of the return happens from this, right? From the value going up. But part of the return is dividends. Dividends are essentially a form of profit sharing that you get from holding these mutual funds. I don't want to miss days in the market, not only because I don't want to miss one of these really important 10 days, but I also don't want to miss out on the dividends I get from holding these shares 365 days out of the year. Now, here's one last aspect to this, and this one is missed by a lot of people. Let's say you figured out number one, you figured out how to time the market, and you've got a complicated but functional tax strategy. And I don't know, you're so good at timing the market that you'll be better off even without some of the dividends that you're going to be missing. What money are you going to use for this? And here's what I mean by that. When we talk about timing the market, what you're saying is, I have money somewhere available, which when I believe the market is low, I'm going to dump in and get more shares than I normally would. Where is that money coming from? Because haven't you established your asset allocation? So let's go back to that and I'll remind you what I mean. One of the most important things is that all investors should establish the asset allocation that is appropriate for their level of risk. For me, as I told you, slightly more, I think it was like 53% was in stocks. And then I forget the exact number, it was something like 8% in cash, and there was 24% in real estate. Okay, so I've determined based on my time horizon and risk tolerance, how much should I have in stocks and how much in real estate and how much in cash. And, I had my little 3% slice of crypto and all these different things. If this is the correct asset allocation, if the market is low and I say, well, now I'm going to buy, where am I getting the money? Am I getting it from my cash? Because if I do, I'm going to drop below 8%, which should make me say, is 8% really the right amount of cash I should have? Doesn't make any sense. No, because, no, I already determined I need 8% cash and 53% stocks. If I'm timing the market, when I do these extra buys, I'm going to lose cash and go up in my amount of stocks. That's not aligned with my correct asset allocation. And if you're comfortable having more in stocks, where you go, well, that's okay, I'll go up to 60% in stocks. Why didn't you have 60% allocated to stocks all along? Why weren't you contributing in that way? So this is the other thing that people often miss. Timing the market implies that you're not actually in an asset allocation that you believe is the right one for you, because you're willing to completely get away from it on the basis that you think the market is undervalued. Very risky to start thinking in those ways. So this is the basic framework. So what does make sense? What makes the most sense, let's see if we can get a cleared image here. Okay, what makes the most sense is that you have regular contributions. Okay, this is called dollar cost averaging. Let's get a new chart here. So no matter what the stock market is doing, and it tends to go up over time, but not necessarily directly, you've got time and you've got price. I'm buying at all these different points. Let's see if we can get a different color. So here's all the points I'm buying at, right? I buy a little bit here, and I buy a little bit here, and 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 on and on and on, okay? And what prices am I paying? Well, here I'm paying this, and here I'm paying this. So now my price is the average of these two prices. Okay, stocks have gone up. Oh no, I'm getting fewer shares now. No big deal. Now my price has become the average of these three. And the whole point of this is that over time, you're buying at all these different prices. It's called dollar cost averaging. You're not making any predictive claim about where stocks are going to be at any particular time, other than you generally believe that they're going to go up. So what's the bet you're making? The bet you're making is, I'm not good enough to pick individual stocks, first of all, for me. I don't know in the short term whether they will go up and down, but because the market tends to go up over time, and I want to be in a tax efficient situation, and I want to collect as many dividends as possible, I am just going to keep accumulating shares at all of these different prices. At the end of the day, what you get here is a price that is the average of all of the prices at which you've bought. You get your dividends, and you get, whatever the number is that people say, the 7% or so that the market tends to return. That's actually pretty good. 90% of fund managers do not achieve that. So that's my message to you today. Don't try to time the market. This makes a lot more sense.